Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we break down the market action as investors celebrate a court's move to block President Trump's tariffs. Plus, a slew of companies announcing billion-dollar deals. Is the M&A market back in full swing? We'll discuss. And we'll bring you the latest finding from a survey of CEOs on where the economy may be heading. All of that and more coming up right here on Catalysts. Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages, still enjoying a little bit of that news of the court's ruling that could block President Trump's tariffs, but we are seeing markets coming off their highs of the session. You got your S&P up just about 0.6%. Your tech-heavy NASDAQ is up about 0.9%. Tech among the biggest gainers in the S&P, along with consumer discretionary this morning. But let's flip the board over to the bond market. Interesting to see yields coming in here. We did see a more immediate action to the front end of the yield curve off the back of somewhat weaker economic data, which we're going to dig into, but we did see the 30-year and the 10-year yield still moving up, though that has now moved back to the downside. You've got your 10-year off about 3 basis points right now. But finally, let's take a look at Bitcoin moving to the downside. Interesting risk on, risk off sentiment across markets here. You've got your Bitcoin still above 107,000, though off about 0.5%. While trade policy and big tech are dominating markets today, we have to touch on the economic data that we got this morning as well. First quarter GDP revisions showing the economy contracting at a slightly less severe rate, shrinking by 0.2% compared to the 0.3 we saw last month. For more on this, I'm going to bring in my co-host for the hour. We've got Paul Grunwald, S&P Global Ratings Global Chief Economist, and also joining us to discuss, we've got Julie Beal, Chief Market Strategist and Portfolio Manager at Kayne Anderson Rudnick. I'm going to start with my co-host for the hour, Paul. Great to have you. Talk to me about how you are viewing the totality of the economic data we got this morning.
Yeah, well, let's start with the GDP. The big number, as you said, was unchanged. It's still slightly negative. There's two big pieces that kind of moved in opposite directions. The first one has to do with front running of the tariffs, because remember that story? We pulled in a lot of imports and they were stocked. Yeah. So we got a little bit of inventory uplift, which was good. But then we had a more serious, I would say, downward revision to consumption growth. Yeah. So 1.8 to 1.2 is a big move. 1.8 is kind of soft landing territory. 1.2 is a little bit harder. So that's negative. We'll have to wait for the future revisions. But I think the takeaway is Q1 looked a little bit softer than we thought originally.
And Julie, to bring you into the conversation, to Paul's point, it seems like that softness in consumption data might have been on the bond market investors' minds this morning. What does that signal to you about risks to stocks if we do start to see a softening in consumers consuming?
Yeah, I think so much of what we can really attribute to the growth that we've enjoyed for the last 2 years has been on the backs of the strength of the consumer. And that's really been tied to the health of, economic gains that we've seen in jobs. What makes me a little bit nervous is when I look at some of the economic data, you're seeing more and more people choosing to do gig economy work. And I worry that that's actually the work that's the weakest in an economic situation, right? Suddenly Uber rides are not as important. Suddenly you're not door dashing quite as much. And so if we hit a patch where there's a weakness in consumer spending, I worry it has a duplicative effect on, the ability for people to kind of continue to find income as prices continue to go up.
And of course, the impact that can have on earnings growth going forward. Paul, bringing you back into the conversation here, where do you see the American consumer today?
Yeah, well, she made a very good point. It's really the consumer and the labor market that are put together. Since the Fed and other central banks started to raise rates, we've had this really resilient nexus of labor demand and consumption. If that cracks, and it hasn't cracked yet, but we've got some weakness. If that starts to crack, I think we go into a down leg with weaker growth. Labor market was okay today. We had a little bit of an uptick in claims. Ongoing claims a little bit higher, but we're nowhere near the panic zone. So if this is a soft landing, which was the original call this year, we're okay. But we're going to have to watch the data for the next couple of months: consumer spending and the labor market.
Let's talk about the labor market a bit, because it also seems that it's taking longer for people to get jobs, and that entry-level work is getting increasingly challenging to get. How concerned are you about that?
Well, we saw two things. We don't see a lot of layoffs, but we also don't see a lot of hiring. So that kind of, quits and new hires things kind of softened up a bit. It looks like firms are on hold. We've got all this policy uncertainty, the ruling last night by the court on the IEPA. might be a little bit of a boost, but we still have this overhang on everything. So that's actually what we're watching. Right, if people start to move away from the discretionary spending, which is the first crack you would see, then what's in that bucket? Is it eating out? Is it travel? Is it DoorDash and things like that? So we'll watch that kind of consumer discretionary bucket first. The essentials are probably going to go through any kind of slowdown, but the discretionary stuff is really where we'd start to see the delta.
And Julie, bringing you into the conversation from a market's perspective, the market has already gone back to its pre-Liberation Day highs this year. Where do you see stocks heading if the tariff headwind is removed? How big of a catalyst might that be, or is that not necessarily the next big thing to boost this market?
I think for the most part, the uncertainty has been the much bigger issue in terms of what's been driving the economy and the stock market. And so my real question is less about whether tariffs have an impact, yes or no. It's more a function of, do businesses feel they have confidence to make kind of longer term decisions? And so the data that I'm paying the most attention to now is CapEx, because so much of CapEx growth that we've had for the last 18 months has really been driven by AI and the hyperscalers. You want to talk about customer concentration. We're like counting on 5 or 6 companies to drive a lot of the CapEx growth. If we see other industries starting to feel more confident that they can do long-term planning, that the tariff overhang is going away, that is a good sign. That's good support for the economy. And if we can get a broadening of CapEx growth, I actually think that gives you longer-term, better fundamentals.
And to your point on uncertainty versus certainty, we have the new taco trade headlines coming in, the idea that Trump always chickens out when it comes to tariffs. How much faith should investors have in that idea driving their investments?
Well, it's concerning, right? Because unfortunately, we told Donald Trump that we have this taco trade. And so I worry a little bit that actually makes him bear down a little bit more and decide to be more gripping on some of these tariff trades. And so I have a little bit of a concern that creates actually more uncertainty. But, for the most part, that's worked quite well for a lot of investors. They've been able to take advantage of that. And I think that actually connects to a lot of, former trades where it was, buying the dip. A lot of people don't want to be caught out on these big moves upwards. Mm-hmm. And so I think you'll continue to see volatility around that because there's so much still uncertainty. And the thing is that the policy changes, they change so quickly and they change immediately, right? They take effect almost immediately. So we continue to kind of see the level of uncertainty as being an overhang for probably the rest of the year at least.
And Paul, bringing you into that as well, I wonder how you're thinking about the data going forward after we did get this ruling that potentially slaps down some of these tariffs going forward. Can we trust the data when we don't know where tariffs stand?
Yeah, well, Julie made a great point. It's really this overhang of uncertainty that's putting a damper on investment, M&A, and we're seeing it in the sub-investment grade stuff as well. But yeah, we've got the court ruling, but if you listen to the administration officials this morning, there will probably be appeals. Maybe they can find other venues. Congress is supposed to be putting tariffs on anyway, right? So we could actually see possibly a shift to that. So I don't think this is the last word on tariffs, but I agree. This is a roller coaster ride, not good for long-term planning and not good for corporate investment.
Certainly. All right, Paul, thank you so much. You're going to stick with us. Julie, thank you so much for joining us. Really appreciate it.
Thank you.
A federal trade court is ruling that most of the sweeping global tariffs President Trump imposed on April 2nd are illegal, exceeding his authority under the International Economic Emergency Powers Act, or IEEPA. Goldman Sachs says Trump will likely find other ways to impose those tariffs and that this ruling poses just a minor setback. Joining us here, we've got Greta Peiss. She is a partner at Wiley Ryan and as well a former general counsel at the Office of the United States Trade Representative. We also still have Paul with us for the conversation. Greta, it's fantastic to get your insights this morning because we are all looking for clarity on what this is going to mean for U.S. trade policy going forward. What is your take on what this ruling means for Trump's tariffs?
Well, I would agree with the analysis that you've cited. It's a setback. It is a ruling that this authority that the president has relied on, the International Emergency Economic Powers Act, or IEEPA, can't be used in this way for these tariffs. It doesn't mean that the president can't find other means or authorities to try to implement this policy. And it's also just the first step in litigation. The administration has already filed a motion to stay or sort of pause the order. and has filed a motion to appeal. So this is certainly going to see further fights in the courts, which creates uncertainty as to whether this ruling will hold. But at the same time, the administration is certainly looking at other avenues to pursue the policy that the president seems to be really dedicated to.
Yeah, so Greta, where do you see this sort of netting out? Do you see the administration being successful in its attempts at further litigation, or do you see them successfully getting their tariffs through other measures like Section 122, which was suggested to the administration in the ruling?
Well, they're certainly going to pursue both avenues. And in the short term, it may be that they use Section 122 that you mentioned in order to displace the tariffs that have been removed, particularly those worldwide tariffs that were set at least currently at 10%. And then at the same time, continue to pursue the courts and try to make their case that, in fact, the IEEPA does allow the types of tariffs that have been imposed. And I think, as Paul mentioned, a third option is to look to Congress. Of course, Congress is considering the reconciliation bill right now, where tax budget issues are on the table. Could the president put before Congress ideas to expand tariff authorities or put in place some of the pieces of his tariff agenda? Possibly.
Mm-hmm. And Greta, my co-host for the hour, Paul Grunwald, has a question for you.
Yeah, I think, Greta, you partially answered it. I was going to ask you, what's the likelihood that some of this actually migrates into Congress? If the president's able to invoke IEEPA, he's got control of the negotiations. But if Congress actually passes the tariff, then I guess they would lose some of that. So how likely do you think that is, that we get some tariff action in the Congress? Or do you think this is going to stay mostly with the executive branch?
Well, I think it's, at the end of the day, I think the political calculus is that it would be a really uphill battle even to get all Republicans on board with expanding tariff authority or putting new tariffs in place, right? That's going to be controversial. You have Republican members of Congress who've expressed concerns about the tariff and the tariff policies to date. Now, that doesn't mean that the president won't test and pursue whether there's an openness in Congress to doing so. And I think, I would just say that to your question about sort of ceding that authority to Congress, there's probably lots of different legislative scenarios you could think of. Certainly, Congress could itself put a 10% tariff in place. It could also put a tariff in place and then leave some discretion through a new statutory authority for the president to raise or lower their tariffs.
And Greta, I also want to get your take on this from a negotiation perspective as a former U.S. trade representative yourself. What does a ruling like this do to the president's negotiating power?
Well, I think that the administration, one reason that they're going to look rapidly at near-term solutions to reinstate or put back in place these tariffs is to retain that negotiating leverage. This is a key trade policy objective of the president. And so even if the tools that they look at are slower or have some restrictions that weren't in place with the tariffs that have been vacated, they want to at least put the threat of tariffs back on the table for these negotiating partners that they've been talking to.
And in terms of how a ruling like this kind of impacts those negotiations, again, as we've sort of heard of like phone calls going back and forth, maybe not, between the administration and several of these countries he announced so-called reciprocal tariffs on April 2nd. Are those phone calls going to start drying up off the back of this ruling?
Well, I don't think so, because I think that trading partners also know that this is the administration has other options, and that this is a policy that the president is determined to pursue. Also, of course, there are tariffs in place that the ruling does not impact. These are the sectoral tariffs, so on steel, aluminum, autos, investigations that are ongoing on pharmaceutical products, semiconductor products, and goods that contain those products. And so we saw some of the outcomes of the UK negotiations addressing, for example, the auto tariffs and making reference to some of those other sectoral actions. So there's still negotiations to be had. There are still tariffs in place. And again, there's still the potential threat of new tariffs using other authorities.
Yeah, Greta, and I guess the other thing we're hearing is with some of the trading partners, I'm thinking of some of the Asian partners like Japan and Korea, some of the deal could be they buy more, U.S. Energy products, or they buy more, pharma, or they might buy more planes from Boeing. So it doesn't necessarily have to be all tariff related when we're putting together these deals. Is that your view as well?
Yes, that's been a part of what the administration has been looking for. It seems like as an outcome of these deals, right, we see tariffs on the table. We see potentially non-tariff barriers, whether that's regulatory or other tax barriers. And as you said, sort of purchase commitments or investments, right? So there's been a broader set of asks and pieces on the negotiating table that the administration has been working with.
Greta, really appreciate your insights, and thank you so much, Paul, for the great questions as well. Appreciate you both.
Thank you.
We're going to have all your markets action ahead here on Yahoo Finance, so stick around. You're watching Catalysts.
Nvidia out with better than feared earnings, margins holding strong, and the stock adding over $200 billion in market cap today alone. But Nvidia isn't just another big tech name. It has become the center of gravity for the entire sector. I'm Jared Blickery, host of Stocks in Translation. Now check out this first chart. It shows Nvidia's market cap as a percent of major indices over the last decade. Back in 2015, it was a drop in the bucket, less than 1% of US semiconductors. And today, Nvidia is nearly half, 45% of the entire Philly Semiconductor Index. But interesting quirk here, if you look at the semiconductor ETF, SOXX, Nvidia is only about 10%, with Broadcom actually a bigger holding despite a smaller market cap. Similar story for XLK, and now arcane SEC rules dating from the 1940s keep Nvidia's concentration in check to a degree for tradable securities, but it still exerts an outsized influence. And let's get back to the chart here, because zooming out even further, Nvidia is now 20% of large cap tech and 6% of the entire S&P 500. Bottom line, Nvidia now moves the entire market like few stocks ever have. Next chart. This is since October 22. This is the Fed pivot low, which kicked off the current bull market. Nvidia alone has added an incredible $3 trillion in market cap, and it wasn't even a $300 billion company when this rally started. Over that same period, the rest of the S&P 500 sector, ex-Nvidia, added $8 trillion, while the entire S&P 500 gained $20 trillion. So when Nvidia moves, the whole market feels it, and that's a lot of market power in just one stock. And here's a different way to see that influence. In this chart, each bar shows how much market cap Nvidia has added or lost each year, alongside tech and the rest of the S&P 500. Now, notice that Nvidia has been up 6 of the last 7 years, including this year, but just barely, adding through May 28th about $16 billion. But here's the catch. Back in 2022, when tech crashed, Nvidia alone lost nearly $400 billion. Concentration works both ways. And the big question now is what happens if Nvidia stumbles? Remember Cisco in 2000? It dominated the NASDAQ at the dot-com peak. Then it lost 80% of its value. Index investors were hammered. Bottom line, Nvidia's market dominance isn't just historic, it is a double-edged sword. But with earnings finally in the rearview mirror, a big market risk is finally off the table for the time being. Tune in to Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, great overview as always. Thanks so much. Now time for some of today's trending tickers. Watching United and JetBlue, Kohl's, and Bath & Body Works. First up, United Airlines and JetBlue announcing a new deal to sell seats on each other's sites. The partnership, called Blue Sky, will also allow frequent flyers to earn and use points on both airlines. United's also going to get access to some of JetBlue's slots at New York's JFK Airport for as early as 2027. The deal is still subject to regulatory review. Next up, Kohl's maintaining its 2025 outlook, betting on its turnaround efforts after reporting better than expected first quarter results. This is the first report since the company ousted CEO Ashley Buchanan and appointed Michael Bender as interim CEO, making him the 4th CEO in 3 years for the retailer. Finally, Bath & Body Works topping first quarter profit estimates boosted by steady demand. The beauty and skincare retailer also maintaining its annual net sales and profit forecasts. The company is benefiting from limited exposure to tariffs since the majority of its merchandise is sourced locally. The shares, though, down a little over 6%. And you can scan the QR code you see on your screen to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, could a series of newly announced deals be a sign that a wave of M&A activity still awaits us? That's next, right here on Catalysts. Several merger and acquisition deals announced recently, including Salesforce reaching an $8 billion deal for Informatica, Dick's Sporting Goods to buy Foot Locker for $2.4 billion, and Elf Beauty acquiring Hailey Bieber's Rhode for up to $1 billion. So, could this be the start of a renewed wave of M&A activity? Our next guest says there are reasons to be cautiously optimistic that the trend could continue. Joining us now, we've got Marc Cooper, Solomon Partners CEO. Marc, it's always great to speak with you. Thank you for making time for Yahoo Finance this morning. Talk to me about what you're seeing and how that's informing your outlook for M&A over the next couple of quarters here.
Well, Madison, thanks for having me on. It's been a pretty good M&A market, as you've just noted, on the corporate side, where the challenges have been is on the private equity side. So I think corporations who are looking to solidify market share or looking to gain critical mass see this as a really nice opportunity to acquire at reasonable prices without the competition from private equity. But the real problem, and what's holding the breadth of the market down, is the private equity community is not participating.
And what would it take for that participation to come back in, Marc?
I think there are a number of things. Clearly, there's all the issues that we're dealing with now in tariffs and other effects on economic behavior. But I think to my mind, if you take one issue and say that's the one that's going to drive it, it's going to be interest rates. It's about price. And the challenge for PE is they made a number of acquisitions, a lot of acquisitions back in the 2021 era, post-pandemic, zero interest rates, and they made them at pretty reasonable prices. And it's hard to get back there. And as you know, prices go up with interest rates going down.
Yeah, absolutely, Marc. My guest host, Paul Grunwald, has a question for you as well.
Yeah, hey, Marc, I think you partially answered it. But yeah, I was going to ask the drivers. It looks like the Fed is on hold for a while, right? They're going to be looking at the impact of the tariffs, and the labor market still looks reasonably strong. We don't have any cuts till later in the year. So if that's the scenario, you announced a couple of deals a minute or two ago. Is that just a bump, or are we going to trend higher? Or are we just going to be wait and see and watch the rate market and watch tariffs?
You're going to continue to see strategic transactions.
Okay.
And there's plenty going on. Last year, we had the best year in Solomon Partners history, and it was largely driven by our strategic activity with a fairly modest PE market, where the breadth of the market is, as we know, is driven by private equity with a lot of the deal flow, maybe not the volume, but the deal flow. And when you have 29,000 portfolio companies that are owned in the private equity community that have, I don't know, on average, 6 to 7 year average life, which is far longer than normal, they got to move them out. They got to trade. That's where you're going to see a real surge in the market. Meanwhile, the markets are open. And if I tell you, we look at our business, we look at how much pitching activity, how much preparation with our sell side activity with private equity, it's a lot. The question is, are those deals going to get out there? Are they going to get done?
Well, talk to me, Marc, about one thing that is a potential headwind we haven't spoken about, which is regulatory pushback here. Noting that Synopsys did get FTC approval for that $34 billion deal to acquire Ansys. Does that give you hope that the regulatory potential headwind is somewhat removed under this administration? How are you thinking about that?
Oh, it's going to be far better than what we've dealt with. They've already reinstated early termination, which was something that the prior administration had taken out, so transactions can come out of review before 30 days. And I believe there will be a far more accommodative regulatory process. And I think, by the way, in general, if we think about the drivers of long-term activity, deregulation is a big issue, both deregulation in the FTC as well as deregulation across many of the industries that are subject to engaging in M&A.
It's interesting, though, Marc, because we've heard some mixed messaging from members of the administration about their approach to deregulation. Obviously, the Treasury Secretary is all for it. But then when we've heard from the regulators themselves, they've said things like, we're going to follow Biden-era regulatory practices. How are you getting clarity on where they're going to net out?
I think this administration has a way of influencing the departments to move in its direction. It's just going to take some time.
Well said. I wonder how you think that that could impact tariff policy, given this ruling that we got overnight that shuts down some of the president's tariffs. And it sounds like, from what you're saying, that you don't necessarily think tariffs are the big thing on the minds of folks who are working on M&A deals right now anyway. So does it matter where these tariffs go?
It matters. It matters. Where you see activity, particularly in the private equity community, again, is on non-tariff related companies. Because again, when you think about private equity, they have to price risk within a very narrow timetable. They're buying in a 5-year hold. So they got to get it right. And so they have to have clear visibility as to what companies are going to achieve in profitability. Tariffs could have an effect on that. Mm-hmm. Strategics, not so much, because they're thinking 10, 20 years out, and they're looking at synergies. So the answer is yes, it is having an effect. But I think everyone believes that this too shall pass.
And I hear your point on private equity, but we haven't had a chance to talk about private credit. What are you seeing, and how is that impacting deal making?
Well, the great thing about private credit, as I was telling one of my colleagues the other day, is typically, been around as long as I have, when the markets went south, there was no deals because the public credit markets closed. Now, when you have private credit, who is a buy and hold investor, they can price risk. It's just a question of return. So they've been an incredible addition to the M&A market and have kept us going for a long time. You've seen some noteworthy transactions of size done with private credit financing.
Marc, I had a source mention to me, they said private credit hasn't had its true test yet. Do you agree with that? And if they haven't, what's that test going to look like?
The test is coming. So part of the issue in private equity is there's probably a fair number of companies that are not in great shape. Mm-hmm. You don't read about them because they weren't financed in the public markets. They were financed in the private markets. And the private markets sort of kicking the can down the road, hoping they can work their way out of it. The answer is they won't. And like anything else, there are going to be some failures. It's not a bad thing, but it's going to happen. And it's going to affect private credit. We just read today, transaction, in fact, I did 10 years ago at home, just filed for bankruptcy. Mm-hmm. And that was a Hellman and Friedman transaction that was bought, I don't know, a $3 billion transaction, but public debt, and pushed them into bankruptcy. But I think you'll see more of that, particularly as the PE markets loosen up. They get to sell some of their good companies. They get to return capital to their investors. And then they're going to clean up some of the difficult things.
Yeah, Marc, maybe a quick question on what that stress test looks like, right? We haven't had a real kind of classical downturn since the global financial crisis. We had the energy 2015-16, we had COVID. What's the stress test? Is it like a stagflation? You mentioned high rates and a slowdown, or what's gonna sort of drive a shakeout if we get one?
I don't think we're talking shakeout here. I mean, the great news about the market is there was some, exuberance in buying back in the zero interest days in 2021. But we're not talking about having a lot of overhang in public debt. In fact, the biggest overhang was X on the financing transaction that he did, and the private transaction he did, and that's all been sold out to the marketplace. So yeah, there are going to be some losses, but those losses will be in the private markets. I just don't see any systemic issues. The stagflation issue, I just don't buy. I mean, tariffs is, to my mind, a one-time effect. I think inflation, core inflation, is very much under control. Yes, is it going to bump up because costs will go up a degree, but it will be once. I don't see it as being stagflation.
Marc, I always appreciate getting your insights. They're fantastic, so really appreciate your time this morning. Thank you so much, and thanks, Paul, for joining the conversation as well. Thank you. Take care. In a programming note, Yahoo Finance will speak with Informatica CEO Amit Walia today at 4 p.m. Eastern. You won't want to miss that conversation. We'll have all your markets action ahead, so stick around. You're watching Yahoo Finance. Business leaders were significantly less optimistic in the second quarter than they were at the start of the year. The Conference Board measure of CEO confidence in collaboration with the Business Council fell by 26 points in the second quarter of 2025 to 34. That is the lowest level since Q4 of 2022, with 83% of CEOs saying they expect a recession in the next 12 to 18 months. Joining us now on this, Mike Archbold, the Conference Board Program Director, and former GNC CEO Paul Grunwald, still with us as well. Mike, it's great to have you here. Talk to me about how much of this collapse is tariff related.
So first, thanks for having me, Madison. And it's interesting because this survey took place basically the week before and the week after May 12th, which was the date that China and the U.S. kind of created a ceasefire on trade and tariffs. And while the responses from the CEOs were less pessimistic in the week following, they remained pessimistic. And not only were they pessimistic, the survey actually inquires about CEOs' confidence or view of the economy now versus 6 months ago, and also 6 months from now versus now. And both of those indices registered as pessimistic. So there seems to be a lot of other things in addition to tariffs. Tariffs is certainly a factor here, but there seem to be a number of things on CEOs' minds.
So what are those other factors on CEOs' minds, especially given the fact that we mentioned in the intro, CEOs do foresee a more high chance of an incoming recession, but you also note that they don't see changes in their workforces coming up. So what are those headwinds that they think that they can stomach without having to lay people off?
So it's a great question, and it's interesting because the numbers that we saw in terms of the CEO perspective is similar to what we saw back in 2020, end of 22, 23, when there was a lot of consideration for recession. Now, we did avoid that recession in no small part due to the fact that companies did not do layoffs. And it appears from what the CEOs are saying, they're going to be in a similar situation, because they're actually reporting that they're anticipating no significant change in their workforce. But by contrast, the number of CEOs who are reporting that they expect to reduce their capital spending actually doubled versus the previous reading.
Yeah, and that's certainly an important economic indicator as well, Mike. My guest host, Paul Grunwald, has a question for you as well.
Yeah, hey, Mike, my question's about this wedge we're seeing between the soft data and the hard data. So a lot of the confidence indicators, including your own, are, pointing south and have been for a while, but the big macro indicators, consumption, unemployment, are kind of hanging in there. So what's your read on that? Is that a lag, or is there some new noise in the data, or have some of the linkages broken down? I'd love to get your take on that.
It's a great question, Paul, and some of the linkages certainly are shifting, right? Because it used to be these were great, predictive analytics, predictive numbers for the economy, and what we've seen is that CEOs are not acting the same as they have in the past. They're skills banking, they're hoarding labor. They're doing these things to make sure that they're well positioned, even if there is a recession coming out of that recession, that they'd be well positioned. But what's happening because of that is the unemployment's not going down. So it's changing the interaction of all of these factors.
And Mike, I want to go back to something you said about capital spending plans going down here. To what extent do you think any rollback of tariff policy might change that capital spending?
Yeah, so again, I think the CEOs will certainly be impacted by that, and I think that as I mentioned, the responses post May the 12th were actually less pessimistic, but still remain pessimistic. So I think that is something that we'll probably expect to continue to see until the CEOs can really get a better feel for being able to manage risks. And as you said, it's more than simple tariffs. It's a whole bunch of things, right? Because if you look at the risks that CEOs prioritize, traditionally, cyber risk has been the #1 risk for their industry that they have cited.
Yeah.
That risk has fallen to number 4 in the most recent survey. And above that is geopolitical instability, trade and tariffs, and regulatory regime, all of which are more significant risks, which the CEOs really feel they need to get a better visibility on in order to be able to allocate capital and allocate labor.
Mike, really appreciate you joining us. Thank you so much for your time, and thank you,
Thanks very
Paul,
much.
as well. We're going to have all your markets action ahead here on Yahoo Finance, so stick around. You're watching Catalysts. Pet care platform Rover expanding its international footprint, bringing the marketplace to 2 new countries and acquiring a European-based dog sitting and walking platform. The company planning to invest $15 million over the next 5 years for further expansion. Joining us now, we've got Aaron Easterly. He is Rover's CEO. Aaron, great to speak with you. I know that Blackstone had taken the company private in a $2.3 billion deal back in 2024. Walk us through how that has impacted your growth story since, and how that's impacting your ability to expand in these areas internationally.
Yeah, overall, it's been a net positive. One of the nice things about Blackstone is they're a pretty long-term oriented investor. So when that transaction closed, we took a look at a lot of investments we were excited about that may have been a little bit more difficult to execute in a public company setting, and decided to go ahead with them. So the further expansion in Europe is one example of that.
And talk to me about, more broadly, how you think about public versus private, having experienced both. What are some of the shifts that you've noticed as you've gone private, and why did that make sense for Rover?
Yeah, I'd say that we are always a company that has been mission first. We want to make it possible for everyone to experience the unconditional love of a pet. The logistics of pet care is one of the barriers to more people having pets, and so that's always our primary focus. There are pros and cons of being public. There are pros and cons of being private. So we're always very situational around what makes sense for the next stage of the company, and being able to be a little bit more longer term oriented in some of our investments that take a little bit of time to develop, made being private a nice thing at this point in time.
And I should mention that for our audience, you can look up private company data, including the likes of Rover, on the Yahoo Finance platform under our private markets page. But I do want to bring in Paul Grunwald, my guest host. He has a question for you.
Hey, Aaron, it's Paul. I've never asked a pet care question before. I'm an economist, so forgive this. But Maddie and I were just chatting before. You know, we're talking about an economic slowdown, and we're talking about consumers having like a discretionary bucket or a necessity bucket. So where do you think the pet care, your business fits in? Is it something that people do on a kind of discretionary basis, or is this becoming more of a necessity as we kind of look through the economic cycle?
Yeah, if you look at pet parents, historically, the view has been that pet parents view it as a necessity. Right. About 72% of pet parents, if you ask them, do they view themselves as a pet owner or specifically a parent, they will say parent. So it's more akin to a parent-child bond than a piece of property. And with that, the pets tend to be the last thing, or spending on pets tend to be the last thing people cut in tough times. That being said, we did see not a reversal of that trend, but a little bit of a moderation in that trend over the past couple of years. For the younger generations, inflation outpaced their income growth. So you actually had a slight shrinking of real income for that group. And for the first time in maybe 20 years, we saw some amount of pet parents be a little bit more modest on how extravagant they were going with their pet food and treats and toys and things like that. But overall, pet parents prioritize their pets in a lot of cases above themselves.
Great to know, thanks.
Yeah, it is great to know. And it's also interesting, Aaron, too, one thing we've been talking about is whether pet parents might also becoming pet babysitters for others amid an economic slowdown. Can you talk to me about whether or not you're seeing an increase in gig economy work on the platform amid a moment of economic uncertainty?
We straddle the line between passion project and gig work. So most of the people that are in Rover are doing Rover as side income. So in that sense, it is kind of like a gig, but they're also doing it because they specifically love pets. And so in that sense, you get people that choose to do this for reasons unrelated to their hourly earnings potential. It's a preference in addition to a job. We have seen an increase in the number of sitters applying to be on the platform. If anything, we have to moderate that a little bit to make sure that the demand ramps in pace with the supply. But we've been very happy with our supply dynamics and the amount of people that are excited to be on the Rover platform.
And talk to me, too, about a stat that you all have. You did a Rover True Cost of Pet Parenthood report indicating that 52% of pet owners are concerned that tariffs will increase pet costs. Just curious what that signals to you about the way that tariffs are impacting some of the consumer sentiment of people who are using your platform.
Yeah. In general, the inflation in the pet economy for the past several years has actually outpaced inflation in the rest of the economy, particularly on the service side, particularly on the veterinary side. For several years, it was also really high on the pet food side, but that's moderated this year. So pet parents are looking at these dynamics and saying, wow, there may be a 10% increase in the cost of having a cat this year, a 7% increase in the cost of owning a dog this year. What are some ways that I can be a little bit more frugal while still prioritizing my pets? But when you add in these other things like tariffs, there is definitely some concern that that's going to push them over the edge, so to speak, in terms of the cost that they're going to have to eat.
Aaron, really appreciate it. Thank you so much for making the time for us this morning. Great insights, and a big thanks to my co-host for the hour, Paul Grunwald with S&P Global as the Global Chief Economist. Really appreciate you making the time for the hour as well. Coming up here, we've got wealth dedicated to all your personal finance needs. Our very own Brad Smith has you for the hour, so stay tuned for more.